In this video, we will explore Warren Buffett's investment philosophy and reveal his top 7 dividend stocks, proven companies that pay their dividends like clockwork year after year. So let's get started. Mark was knee-deep in financial reports when he stumbled upon Warren Buffett's latest stock picks. His eyes lit up like a kid in a candy store. This is gold, he thought. Diving into the Oracle of Omaha's top dividend stock choices, it was like finding a treasure map. But instead of X marking the spot, it was dollar signs. Warren Buffett, the investing world's equivalent of a rock star, has a knack for picking winners. His strategy is about something other than making a quick buck. No, Buffett's all about playing the long game. He's famous for saying he likes to buy stocks to hold them forever. It's like planting a tree and watching it grow into a mighty oak. But instead of acorns, you're investing cold, hard cash in the form of dividends. Now let's break down Buffett's top 7 dividend stocks he's betting on for the long haul. Number 7. HP. HP Inc. is a name that's hard to miss in the tech world. They're the folks who bring us all sorts of gadgets and services, from personal computers to printing products and even 3D printing and gaming gear. They've got their hands in a bit of everything tech-related. The company splits its operations in 3 main areas: personal systems, printing, and corporate investments. When discussing personal systems, HP offers a vast range of services. Think commercial and consumer desktops, laptops, detachables, convertibles, workstations, thin clients, and retail point-of-sale systems. They also throw in displays, hybrid systems, and a bunch of software and services. If you need something for computing, HP has it. HP shines in the printing segment with consumer and commercial printer hardware. It has the supplies, services, and solutions to match. But HP is not just about your everyday printing needs. It's also pushing the envelope with graphics and 3D printing, especially in the commercial and industrial markets. HP is big on personalization too, making sure its printing tech meets various unique needs. The corporate investments segment resembles HP's playground for new ideas. Here, they focus on business incubation and investment projects. It's all about looking ahead and finding new ways to grow and innovate. On the numbers side, HP's market cap is a cool $37.293 billion. About 978.56 million shares are floating around, so there's a lot of action there. The stock sees an average trading volume of 5.88 million over 10 days, which means people are interested in what HP is doing. For those eyeing dividends, HP doesn't disappoint. They offer a dividend of $1.10 and a yield of 2.89%, making it a solid pick for anyone looking for some steady income. The beta is at 1.11, meaning the stock price can be a bit more up and down than the market. It's something to keep in mind if you're thinking about investing. Number 6. Medronic. Medronic is one of those buy and hold stocks that can appeal to a wide range of investors. Whether you're into AI, healthcare, or looking for reliable dividend income, Medronic has something for everyone. One of the most incredible things about Medronic is its role in the healthcare AI revolution. They've teamed up with NVIDIA, a big name in AI, to develop intelligent medical devices. NVIDIA's healthcare VP Kim Powell mentioned that this partnership is about speeding up AI innovation. The goal? To make better clinical decisions, reduce variability in medical outcomes, and improve patient care overall. With NVIDIA's reputation for dominating its industry, Medronic is set to gain a lot from this collaboration. Medronic is also riding the wave of growth in the medical device industry, which is expected to hit $795 billion by 2030. This industry has been growing steadily at about 5.2% per year since 2015. Medronic has one of the largest shares in this market, second only to big firms like McKesson Corporation, which also deals in pharmaceuticals. This vital position means Medronic is poised for long-term growth. For value investors, Medronic is a gem. The company's price-to-book ratio is a reasonable 1.9x, indicating it's not overpriced. Plus, it offers a total yield of 5.3%, making it a solid pick for building a resilient portfolio. Medtronic's market cap is $104.197 billion, showing its presence in the industry. They have about 1.28 billion shares out there, and over the past 10 days, they've averaged a trading volume of 5.6 million, so there's plenty of interest. Financially, Medtronic is strong. Its revenue for the last 12 months is $32.364 billion. Its hefty gross margin of 65.73% and net margin of 11.44% highlight its profitability. And let's remember the dividends. Medtronic pays out $2.80 per share, yielding 3.45%. That's reliable income for those looking for steady returns. Number 5. MasterCard. MasterCard is a giant in electronic payments, boasting a market value of $192.7 billion and a modest dividend yield of 0.5%. It's no wonder Warren Buffett has taken an interest in this powerhouse. Buffett, known for his keen eye for companies with profitable long-term growth potential, emphasizes that time is the friend of the wonderful business, the enemy of the mediocre. This mindset likely influenced Berkshire Hathaway's decision to initiate its stake in MasterCard in 2011. They saw the writing on the wall. Consumers and businesses were moving away from cash and checks, opting for electronic payments. MasterCard focuses on transaction processing services. Unlike traditional banks that issue credit cards and extend credit, this means they earn a percentage of each sales dollar processed over their payment network without the risks associated with traditional banking activities. This business model is a significant part of what makes MasterCard a safe bet for the long run. The market opportunity for MasterCard is enormous, with estimates suggesting they have the potential to capture payment flows around $225 trillion. It indicates substantial growth potential, even with MasterCard's already dominant presence in the industry. Over the past 5 years, MasterCard's share price has grown significantly, increasing by 96%. This impressive performance underscores MasterCard's leadership in the electronic payment industry and makes it a compelling candidate for anyone looking to buy and hold in their dividend stock portfolio. Number 4. J.P. Morgan. Warren Buffett, the legendary investor, isn't known for having many regrets about his financial decisions. However, he does have a notable one: not buying more shares of J.P. Morgan Chase. In an interview with Yahoo Finance's Andy Serwer, Buffett admitted, "I should have bought J.P. Morgan. I wish we bought a lot more. I made a mistake." J.P. Morgan Chase stands out for income investors, especially those prioritizing high-yield dividend stocks. But here's the kicker: there's much more to consider than just the yield. Steady earnings, ample cash reserves, and liquidity are essential for consistently paying dividends. A stock's ability to generate robust returns year after year is crucial. Blending capital appreciation with those dividends. J.P. Morgan Chase ticks all these boxes. For starters, the Zacks consensus estimate for its earnings has seen positive revisions, signaling optimism about its future. As of now, J.P. Morgan holds a strong buy rank. This isn't just based on speculation. Its shares have surged more than 15% this year, significantly outperforming the industry's growth. Over the past 3 to 5 years, J.P. Morgan has achieved an impressive 12.5% earnings growth, well above the industry average of 6.1%. The trend seems promising, with a projected earnings growth of 24.8% in 2023. J.P. Morgan isn't just sitting on its laurels. The company has been strategically expanding its reach through domestic and international acquisitions, diversifying its revenue streams. After successfully clearing the 2023 stress test, J.P. Morgan plans to increase its dividends by 5% to $1.05 per share. They're also rolling out a share repurchase program, another positive signal for investors. J.P. Morgan Chase is a compelling choice for those seeking a solid dividend stock to hold over the long term. Regardless of market conditions, it delivers consistently, making it a reliable option for any investor's portfolio. So while Buffett might regret not buying more, there's still a chance for savvy investors to see the value in J.P. Morgan Chase today. Number 3. Visa. Visa Inc., known by the ticker symbol V, is a giant in the payments processing industry, handling electronic payments like credit and debit cards. These days, most people prefer using plastic over cash, and the industry is booming, with predictions that it could generate over $3 trillion in revenue soon. Visa's dividend yield is currently around 7%. While that might not sound high at first glance, it's because Visa's stock price has grown significantly. If you had invested $1,000 in Visa 10 years ago, it would be worth around $5,500 today with dividends reinvested. But the growth story isn't over yet. Visa has a 10-year dividend growth rate of 18.49%, which is impressive. Let's say Ben decides to invest $10,000 in Visa now. After 10 years, his initial investment could grow to approximately $69,500, paying an annual dividend of about $1,079. If Ben extends his investment horizon to 20 years, the same investment might grow amazingly to a total value of $371,500, with an annual dividend income of $5,199 or $433 per month. Visa is also known for consistently increasing its dividend over time. They have plenty of room to keep raising it because they only use about 20% of their earnings for dividends. This low payout ratio is a good sign for future dividend growth. Regarding stock price, Visa's shares have increased by 29% since last year. Even with this rise, their stock is still reasonably priced compared to similar companies in the industry. Visa's valuation looks sensible and its financial health is solid, making it a strong player in a growing industry. Number 2. Palantir. Palantir, trading under the ticker symbol PLTR, is one of those stocks that simply can't be ignored. Renowned for its cutting-edge data analytics and AI-driven solutions, Palantir has carved out a significant niche in both the public and private sectors. Government agencies, commercial enterprises, and nonprofit organizations all rely on its platforms, Palantir Gotham and Palantir Foundry, to make sense of complex data and drive informed decision-making. Despite some ups and downs in its stock price, Palantir's growth potential remains strong and resilient. The stock has consistently traded around the $25 range this year, which is a good sign. The company continues to secure high-profile contracts such as recent multi-million-dollar deals with the U.S. Department of Defense and cutting-edge space companies. These contracts provide steady revenue streams and reinforce Palantir's reputation as a trusted partner in the data analytics space. With a market cap of $62.843 billion and 2.23 billion shares outstanding, Palantir is a significant player in the industry. Over the past 10 days, the stock has averaged a trading volume of 45.42 million shares, indicating strong interest from investors. Financially, the company is solid, with a revenue of $2.334 billion for the trailing 12 months. Palantir boasts an impressive gross margin of 81.16% and a net margin of 13.04%, highlighting its efficiency and profitability. Number 1. Berkshire Hathaway. Berkshire Hathaway is a top contender for anyone looking for buy and hold stocks. This isn't surprising given its reputation and the legendary Warren Buffett at the helm. The company's diverse portfolio, spanning more than 50 companies across various industries like real estate, transportation, energy, and consumer goods, makes it an easy choice for investors aiming for a balanced portfolio without the hassle of picking numerous individual stocks. Investing in Berkshire Hathaway aligns you with Buffett's value-first investment philosophy. His strategic moves, such as cutting back on underperforming stocks like Chevron to boost cash reserves, showcase a prudent approach to rebalancing. This tactic protects your portfolio from economic downturns and positions it to seize opportunities when other companies face challenges. Berkshire Hathaway offers a straightforward way to leverage the expertise of one of the world's most successful investors. For those with a long-term perspective, few buy and hold stocks can match the stability and growth potential of Berkshire Hathaway. The company's market cap is a staggering $964.495 billion, reflecting its massive scale and influence. There are about 1.44 million shares outstanding. What's impressive is the company's revenue, which stands at $368.958 billion for the trailing 12 months. This massive revenue stream is coupled with a gross margin of 21.25% and a net margin of 20.12%. These margins indicate strong profitability and efficient management. Berkshire Hathaway's diversified holdings provide a cushion against market volatility, whether through its real estate ventures, transportation assets, energy sector investments, or consumer goods. The company has its fingers in many pies, ensuring a steady flow of income and growth. This diversification is critical to achieving stability in your investment portfolio. So if you're a long-term investor looking for a solid buy and hold stock, Berkshire Hathaway should be at the top of your list. With Buffett's strategic insights and the company's robust financials, investing in Berkshire Hathaway means you're banking on one of the best in the business. Now, which of these stocks will you be adding to your investment bucket? Let us know in the comments section below, and don't forget to subscribe to the channel. See ya!